There are three parts to Chapter 2. Part 1, we're going to discuss the accounting formula and the concept of debits and credits. An overview. We're going to explain in this particular lecture what a transaction is. It's financial. What is an account, where we collect information about a specific type of transaction. Types of accounts, assets, liabilities, equity. The concept of debit and credit. Now, the double entry accounting and recording financial transactions we'll cover in Part 2, and then the trial balance we'll cover in Part 3. So, we'll go back to that accounting equation. So you have to remember always that assets must equal liabilities plus stockholders' equity, and stockholders' equity is broken down between common stock and retained earnings, which includes revenue minus expenses minus dividends. Revenue increases retained earnings, expenses reduce retained earnings, and dividends reduce retained earnings. An account is a record of all financial transactions related to a particular item over a period of time. So, if you look at a financial statement and you see the cash account and the amount doesn't look right, you would first go and look at the account and look at the types of transactions that have occurred. So, asset accounts would be cash, supplies, and equipment. Liabilities would be accounts payable, anything with payable at the end of it. Stockholders' equity would be common stock and retained earnings. Now, what we have is every company, and if you currently work, your company has one too, it's called a chart of accounts. And the norm we give accounts numbers because then when we list them all, they appear in financial statement order. So, all assets begin with a 1. So, if you might have 1,000 might be a cash account, 1,010 might be your accounts receivable. So that's how that works. Liabilities are assigned a 2. Common stock and dividends usually start with a 4. Revenues with a 5, and expenses with a 6. Now, each financial transaction will have a dual effect on the basic accounting equation. If total assets increase, then liabilities or stockholders' equity increases by the same amount. If total assets decrease, then liabilities or stockholders' equity decrease by the same amount. Business transactions always include two parts, giving and receiving. Accounting is based on a double entry system. Each transaction affects at least 2 accounts. There could be more than 2 accounts, but there can't be less than 2 accounts. The accounting equation always balances before and after every transaction. Now we'll talk about an accounting tool. It's called a T account. You won't see this anywhere, but we use it to represent what an account looks like in the general ledger. It has an account title. Normally it'd have a number. The debit is always the left side. The credit is always the right side. Every transaction has both a debit and a credit, but not in the same account. What are the rules? Debits and credits are neutral. They're not good or bad. Means either a decrease or increase depending on the type of account. That's what you have to remember. So, debit credit does not mean increase, decrease. It depends on where the account falls in the accounting equation. Normal balance is always the side that increases the account. So if an account increases with credits, the normal balance is a credit. If a balance is not, quote, normal, it indicates a negative amount. So now let's go through some T accounts and we'll look at how things are increased and decreased. So for assets, we increase with a debit and we decrease with a credit. So the normal balance is a debit. For liabilities, we decrease with a debit, we increase with a credit. So, the normal balance is going to be a credit. For common stock, we decrease with a debit, we increase with a credit, and so that's the normal balance. For retained earnings, we decrease with a debit, and the normal balance is going to be a credit. For revenue, we decrease with a debit, so since we increase with a credit, the normal balance is going to be a credit. For dividends, we decrease with a credit, the normal balance is a debit, and for expenses, we decrease with a credit, the normal balance is a debit. Please memorize this. Actually, just print out this slide. Knowing the normal balance of an account is important because if an account does not have a normal balance, it is a sign that something is wrong or you need to reclassify an account. An example is accounts receivable cannot have a credit balance. What that means is you've been overpaid, which means now it would be a liability because you've got to pay the money back. Debits and credits. You debit to increase assets, dividends, expenses, and credits to increase liabilities, revenue, common stock, retained earnings. Do not proceed without memorizing these rules. So now at the end, let's walk through an example. Now, supplies. What type of account is this? It's an asset, so we increase it with a debit. Notes receivable. What type of account is this? It's an asset, which means we increase it with a debit. Fees earned is retained earnings, so we have to increase with a credit. Dividends is part of retained earnings, but we increase it with a debit because it reduces retained earnings. Accounts payable is a liability, we increase with a credit. Salaries expense is retained earnings, but since it reduces retained earnings, it's a debit because the normal balance of retained earnings is a credit. Capital stock is equity, we increase with a credit. Accounts receivable is an asset, we increase with a debit. Equipment is an asset, we increase with a debit. And notes payable is a liability, and we increase with a credit. So that concludes this part.